Hey traders, welcome to another global macro update. In this video, we're going to be going over some economic data that came out, looking at the economic calendar, looking at the possibility of central banks completely saving the economy. And there is no recession, guys. There is no worry. The Fed is able to completely hold the economy up with no problem at all. That's what the bulls are thinking, and we're going to look at some different times in history where central banks have tried to prop up economies when they're failing and how they turned out, because we have been getting some discussion in our Discord as well as on our YouTube channel talking about don't fight the Fed, which I do agree to some extent, but I don't think that just being able to print money will actually solve this economic downturn that we are seeing. It's only just going to create more problems down the line, in my personal view. So let's look at the economic calendar here. First things first, we got the non-farm employment change to come out, worse than the actual forecast. We got crude oil inventories today as well. Tomorrow, we got initial job loss claims, and on Friday, we got the non-farm payroll and the unemployment rate. Forecasting at 16%, so we'll see how that turns out. So quick look at the non-farm employment change, which is the monthly change in non-farm private employment based on the payroll data of approximately 400,000 U.S. business clients. So we can see the actual was over 20 million here, 20,236,000. Which is unbelievable. When we look at 2008, which was right here, obviously it's a blip. It's an absolute blip. And we look at 2001 right here, which is a dot-com bust, which is even a smaller blip. So if we're looking at the actual effect of how devastating this is, look at the employment change. Like, that's unbelievable. Not a whole lot more going to be discussing on that. These numbers are just unprecedented. We haven't really seen anything like this before. So I do think that some people are not really taking into account the actual economic data that is coming out and looking at the previous data that came out in other recessions and comparing them and say, hey, how bad is this compared to previous recessions? And in a lot of different economic statistics, they are pretty damn bad. All right, this is the total non-farm private payroll enrollment. So this is in the thousands. We can see that, yeah, the biggest drop-off we've seen since this chart has begun. We saw it was pretty smooth, slowly dropping from 1 month to 1 month on this chart during the financial crisis of 2008, 2009. And basically right now we're seeing an absolute plummet. We went from 130, let's say, to basically 110. On the total non-farm private payroll enrollment for the number of people in the thousands. So obviously, massive drop. We haven't really seen anything like this. The market hasn't really moved a whole lot. We are holding our right shoulder within the S&P 500. We'll get into the different charts a little bit later in the video. But yeah, these numbers are coming out, which are unbelievable, but they aren't really affecting the market just yet. Now, a lot of people are thinking the Fed will be able to hold up the markets until COVID has passed, and then people will be able to purchase stocks and equities again, and things will go back to normal. So that's it. That is a speculation from the bulls. I personally don't believe that is going to be occurring because of the more macro, larger time frame viewpoints that I have for the small-term debt cycle, large debt cycle. As well as we'll look at some of the, I guess, the most macro you can really get, looking at the time frame of different empires, because that's probably the most macro you can get. But there is some confluence with the United States having, basically 100 years of power and what previous empires have had. All right. Banks are facing huge credit losses as their customers suffer through the pandemic, S&P warns. Let's dive into this a little bit. S&P Global Ratings revised its outlook on the ratings of 13 U.S. banks to negative from stable, and said that the pandemic will hit hardest for those lenders that are most exposed to industries such as commercial real estate and consumer lending that are already being slammed by the virus-driven stress. So they changed their ratings for 13 banks. Definitely something significant. Even with the unprecedented measures being taken by the federal government and Federal Reserve, the bank asset quality, net interest margins, and earnings are coming under massive pressure, and banks are facing credit losses and capital declines if the crisis lasts a long time and the recovery isn't strong enough. So that is our speculation. So we'll see how it goes, but they are having signs of something similar to 2008, where there's going to be defaults on loans, on individual mortgage loans, and on company loans. So yeah, if they get as a high percentage, we saw in 2008 they were over 10%. So obviously, as they go up, the banks get squeezed. Fed is propping up companies it had warned banks not to touch. Another thing on Bloomberg here. For years, the Federal Reserve warned that too many high-risk companies were engaging in fuzzy accounting that bump up their earnings, making it easier for them to obtain loans. The practice was driving up corporate debt to excessive and worrisome levels, regulators basically said. And we said that we said this a while, but the Fed actually said rewards the worst abusers. The Fed move rewards the worst abusers, said Mark Carey, former Fed official. People will see this as a backup, and in the future, they will be encouraged to take on really high leverage. So basically, if you have a zero risk trade, meaning that your upside is potentially unlimited if you're longing. For the downside, you have no downside now because the Fed is printing money, buying up those assets that are highly risky, like these junk bonds, like the federal government is saying, or the Federal Reserve is saying that they're purchasing. So they're really putting high-risk investors in a situation where they are able to leverage a significant amount because they have no downside, it seems like, which is obviously a very, very difficult thing to try to comprehend as a person who's trying to understand reality, because if bad companies and companies who are taking out loans and not succeeding and not being profitable and not being a productive member of society, if those companies are able to basically never go bust, investing is kind of upside down because there's no risk, there's unlimited upside potential, and this isn't a free market anymore. This is not capitalism because you don't have any risk on some of them, and you do have basically a fixed, rigged game from the Federal Reserve. They literally are like the bank in Monopoly, and they can just print more currency and buy up whatever they want, and if anything goes bad, basically, they just say, you know what, that's not a problem. We'll just give you more money from our printing press and go on your merry way. And there's no risk, really, which is unbelievable. So we'll go on to the next one here. Not going to go more into this. They do talk about the fidgeting with numbers or the fuzzy accounting, which is actually going to be the EBITDA. So at issues is the trend among many leverage companies to adjust a key measure of their result, known as earnings before interest, taxes, depreciation, and amortization, or EBITDA for short, to make them appear more creditworthy. So basically, people are fudging the numbers, using this EBITDA number in order to try to make them make them look more profitable or creditworthy, which then they can take out higher loans, more significant amounts of capital to try to basically grow their company exponentially. But it creates some hazards, as we can see. Carey and others also noted that the Fed's motivation to lend support to even more businesses and to prevent widespread waves of bankruptcy from further hobbling the economy is understandable, but they also worry about the messages sending to companies and lenders. 100%, if you have zero risk on the table, you're going to get more aggressive investors taking on more and more risk, adding on to their levered position. Obviously, if you have investors that think they have zero downside potential and have unlimited upside potential because the federal government can print unlimited money and will always have their back, that, in my opinion, is a recipe for disaster. No central bank can print their way out of an negatively economic situation, basically, in my personal opinion. Inevitably, they will have to face reality, in my personal view. You can't print value. You can print currency, but you can't print value. And if they continue to do this, if they print more money to try to save the economy, yes, in my opinion, there will be significant debasement of the currency, which will lead to other issues. So basically, in my opinion, you kind of got two options. You could not print as much money now, face reality sooner, but you won't have the aftermath of basically major debasement, which is painful now. Or you can kick the can down the road like a lot of policymakers are doing and say, we can print a lot of money now, put a big band-aid on it, but then when that band-aid gets ripped off, it's going to be even more painful next time. But then the situation is, how about that next time they just get a bigger band-aid on? And then obviously that is a vicious spiral. So this is the household debt versus the corporate debt. The red line on this chart is the household debt, and the blue line is going to be the corporate debt. We can see that before 2008, right around here, we saw a massive spike in household debt, and that diminished quite significantly. We've actually gone down quite a bit from our highs of 2008, where we had the highest amount of household debt. But what's surprising is, yes, we did have a huge rise in corporate debt, but that corporate debt came right back to the high. We can see that was the high in 2008, and now the amount of corporate debt in the United States is at its peak again. Whereas the households, I think, took their lesson. They understood, oh shit, not having a savings fund or being over leveraged is not a positive thing. I can get really wrecked in this situation. So I think a lot of people, individuals, learn their lesson. But corporations, because they have different CEOs and it's not a single person, it's an entity within itself, the mindset is a little bit different. So corporations, yet again, just piled on more and more and more debt. They took out more and more loans to try to obviously grow the company. And loans aren't necessarily a bad thing, but if you're an over-leveraged company, obviously that has some negative consequences if there is a negative situation that does come in the economy, in your sector of business, whatever the case may be. So definitely we do see high levels of debt in corporations, not so much in households, but we're at the same levels that we had in 2008, basically at the all-time high for the amount of debt that corporations have in the United States. So this is going to be the central bank assets to GDP for the United States. So what this shows is a percentage of the central bank's assets to the GDP for the entire nation. So as we print more and more money like Japan, this number is going to get even greater. Japan at one point, I don't exactly know what it is. We see a chart right here. Yeah, it's over 100%. So basically the central bank's assets is greater than the GDP of an entire nation. That's unbelievable, but that is the reality of Japan. Now you're saying, why in the world, let's just move this here, why in the world does Japan, which is the balance sheet of assets percentage of GDP, exact same chart as this, except this shows US, Eurozone, UK, and Japan. So we see the US sitting at around 19%. Yeah, around 21, I guess, on this chart. Shows 19 on this chart, but around that. And then Eurozone is around 39%. We see UK at 28%. We don't have all the data there. And then we see Japan absolutely ballooning with over 100% of their balance sheet assets as a percentage of their GDP. So basically, when governments are saying we can print a lot more money, look at Japan, this is what they're talking about. So basically, the United States can print 5 times what they think, 5 times the amount they can right now, and they'll still remain with limited amount of inflation or even deflation due to the demographics, the lower velocity, because Japan has done it. Japan has created a shit ton of money compared to every other nation. They've printed more money than almost anyone, really, in a first world nation, not talking about Zimbabwe or Venezuela or something. In a first world country, Japan's up there for the highest amount of currency printed, and they're obviously surviving. They've actually are suffering from deflation rather than inflation. So America is looking at Japan and saying, hey, They printed a shit ton of money. They were able to do unlimited QE and basically alter the balance sheet of the BOJ, Bank of Japan, to a point where they have more assets under their balance sheet than the entire GDP of the freaking nation. Yet they are still surviving. They don't have massive deflation. They have stagnation where it's slowly going sideways. They're not really seeing any growth in real estate and stocks. They haven't even hit their high from the asset bubble back in the late 80s. So it's not great economically for Japan, but they're not going into a spiral like Greece where they're just taking on too much debt, or they're not seeing hyperinflation like Zimbabwe or Venezuela where their currency is debasing faster than you can basically say debasement is how fast they were debasing. But yeah, something to note is Japan had been doing this for a while, and they haven't seen massive inflation yet, but there are major repercussions with that, and we'll talk about that right now. So basically this discussion is, will the Fed be able to save the economy in the United States, or at least the stock market? Because that's what a lot of people are thinking, is the Fed will save the day. Mr. Powell is Superman. He can basically create demand, aggregate demand out of thin air, and everything will be fine. That is the idea from the bulls. Central banks can print enough money to solve all problems, and Keynesian economic theory is the right way to go about handling this problem. This is the idea from the bulls, in my view, is a lot of bulls are Keynesian economists or have the idea that aggregate demand created by central banks will solve this problem, period. Do not fight the Fed. They are God. They are your fucking God. They will be able to save everything. Don't worry about it. That is the only idea that bulls have, in my personal belief. I just don't believe it. I just don't think that that's going to be a possibility in the long run. And we'll discuss the BOJ and Japan's economy during the boom and bust and what we can extrapolate from that case study. So, the diminishing effects of Japan's quantitative easing. We've went over this little post in Investopedia before, but we will go over it again because I think a lot of people are looking at news, and obviously news articles are saying that the Fed has been doing great. They've been taking a lot of action. They'll be able to save the economy from COVID. And to some degree, yes, they have been taking very quick action and very aggressive action, a lot more significant compared to 2008, which has provided levels of demand. But in my personal belief, as more and more QE gets implemented, the power of that QE will diminish, and we'll go over it right now. The country, Japan, is a case study in modern macroeconomic policy and exemplifies why governments and central banks cannot control the economy in the way that many textbooks suggest. Quick thing, you think that economists in power, kind of controlling the economy, are absolute geniuses. They've never done this before. Negative interest rates is a theory. It's a theory. They don't know what it actually will do in the long-term macroeconomic viewpoint. They have no fucking idea. You can create ideas, you can create hypotheses, but at the end of the day, these are not tested. Same as QE. QE is not tested. It's a theory. And it's only been, let's say, 11 years since they've introduced this brand new theory into the world. They don't know what the repercussions are. They don't know what the reaction is to their action that they are taking. They don't know. They're not as smart as you think that they are. Japan's central bank, the Bank of Japan, BOJ, has pursued decades of unconventional monetary policy. Starting in the late 1980s, when the asset bubble was at its peak, it peaked in basically 1990 and has been in a descent since the early 90s. The BOJ has deployed strict Keynesian policy, which is what Americans have, including more than 15 years of quantitative easing or the buying of private assets to recapitalize businesses and prop up prices. This is exactly what American policymakers are doing. They are Keynesian economists, meaning they are going to print unlimited money in times of economic turmoil in order to try to create and prop up aggregate demand. They're trying to create basically fake demand by printing money out of thin air and expanding the budget deficits and ballooning it to unproportionate levels because they think that as long as you're able to buy up your debts like Japan has been doing, you could basically run this system over and over and over again. So it's not sustainable in my personal viewpoint, but everyone has their different views. Despite these efforts, there's strong evidence that Japan's easy money policies only produced an illusionary growth while failing to improve the fundamentals of a stagnant economy. The more Japan's leaders tried to stimulate their current country's economy, the less it responded. So I do talk about stimulus sort of like a drug to a drug user. When you first start stimulus or a drug or whatever, you're going to have major effects. It's going to hit you super hard. You're going to be like, holy shit, I feel good. But as you take the drug more frequently and more aggressively, you're going to get less effects from that drug. Like, let's say you're doing a drug, you have 1 unit of that drug, and then you're on top of the world, and then in a week, you do that same 1 unit of that drug, you're going to get less of an effect because you built a tolerance. Now you might have to do 2, and then you feel that same level of high. And then 2 weeks from that point, you want to go and do that again, and then you have to take 3 to get that same level of a high. In my opinion, it's very similar to stimulus. Yes, in 2008, it worked great because it basically took us from a potential depression back into a propped up artificial economy, in my personal belief, but it did help out. But now we're seeing stimulus come in again, and yes, it does look like it is helping, but as the stimulus comes in, as there's more and more injections of liquidity into the market, I think it's going to help less and less and less. All right. Stagnation begins and the government steps in. Japan was effectively in a bubble economy propped up by cheap paper. Japan turned to Keynesian remedies, printing money, lowering interest rates, and increasing the government deficit. That is exactly what America is doing. They are Keynesian economists. They are printing enormous amounts of money. They have lowered interest rates to a point where they are almost zero, even thinking about negative, and they're increasing the budget deficit by an exorbitant amount, like we've talked about in many videos before this. A series of rate cuts between 1991 and 95 left the discount rate at 0.5%, just above the zero bound. Fiscal policy was aggressive during the 1990s when Japan attempted 9 stimulus packages during the decade, totaling 140 trillion yen, or the equivalent of $1.3 trillion. These measures were unprecedented for a modern industrial power like Japan, and yet there was still no recovery. So what I'm trying to do is learn from previous economic market shocks, basically, of debt bubbles, because America is in a major debt bubble right now, or an asset bubble, you could say. Real estate, stocks, most traditional assets, in my opinion, are inflated due to the Keynesian remedies that we've talked about, printing money, lowering interest rates, and exploding the government deficit. So in my view, it's still definitely something that could happen in terms of the stock market going down. We've seen the Bank of Japan tried everything to try to help, and the more they meddled in the economy, in the fiscal monetary policy, the worse it got. Interest rate manipulation and mounting huge fiscal deficits have not helped Japan's economy for nearly 30 years. The effectiveness of the Keynesian remedies employed should eventually be called into question. Otherwise, the United States and Europe seem doomed to follow in Japan's footsteps. So what I don't understand is, yes, Japan has tried to solve their issues, and they haven't been able to do anything for nearly 30 years. We're in the exact same footsteps as Japan in terms of a major asset bubble, as well as, in my opinion, the demographic cycle being a little bit different. Japan, on average, has a 10-year older generation than the United States. So if you're looking at the demographic cycle with a huge demographic coming into an economy, it's first inflationary, and then it gets very deflationary. So in Japan, with 10 years before, in the 90s, that was kind of the peak of their economic boom, in a sense, where the largest amount of individuals were at the peak of their workforce, and they were buying up everything they possibly could, because obviously you have more money when you're at the peak of your work life. But like we saw, that large demographic moving more towards the retirement age, that's going to create a massive amount of deflation. And with 10 years lagging behind for the States, it kind of makes sense as to where United States is going. And I do think that Japan is a really good case study to understand, or try to understand, how this could play out, because I know a lot of people are talking about inflation, hyperinflation, but in my view, there is more of a fear of deflation in the short term because of the very, very significantly reduced amount of velocity and the demographics of the United States. But yeah, we'll see how it goes. I've been talking about this for a while. Markets haven't been doing a whole lot, but yeah, we'll see where it goes. Last thing I want to talk about is the global reserve currency. We know that the United States dollar, USD, is currently the global reserve currency. Going to get a little bit of coffee here. And we can see it within this very, very macro long-term chart right here. So in basically 100-year gaps, give or take, we see Spain 1530, 1641, a little over 110 years, 1642, 1720, a little less, 1720 to 1815, a little under 100 years. So we can see on average, we can see it's about 100 years, give or less 10, 15 years, but it's pretty well bang on. And it's not going to be one sudden shift. It's not like that one day Spain's currency turned from a global reserve into the Netherlands. It's not a single day. It takes time for these to evolve. But we can see that in the 1920s, when the Federal Reserve was created, that was the new global reserve currency, really. And, well, I think in 1971, really. But we can see that there was a new major world currency, which is the US dollar, in 1920s. And 100 years post that, we're in 2020. So looking at what happened in the past, obviously these aren't going to be perfectly precise, but you know, we're coming to a point where we could see a new massive monetary shift, and we could even see the United States empire slowly start to fall, which is obviously a little bit scary, because when any empire does start to crumble or fall, they will use its military to try to hold its power, which obviously makes sense. Rome did that, and basically every other country which has had initially a great empire that kind of controlled the world, to then them falling, they're going to come out with a bang at the end of their kind of standing for the great empire. So we talked about China and America. We talked about their tension. They talked about the possibility of them having further tension as time goes on here. China creating the One Belt, One Road initiative, basically creating infrastructure all over Europe, Africa, Southeast Asia, and obviously mainland China. Huge projects that they're working on. And yeah, we'll see how it goes. I don't exactly know what's going to happen, but we do see that in the global reserve currencies, America is kind of stretching out to be in the 100-year range right now. And in terms of the standing of great empires, we did see a peak here. I don't exactly know when. Kind of seems like the 1960s or 70s. And then we saw a decline since then. And then China has been increasing, we can see right here, from the lows in the 1950s to then we are going back up here. So there's definitely going to be some turbulence between the tension of China and the United States. So we've been talking about that, but this, in my opinion, is a really good understanding of not just the last couple hundred years, but all the way, 1500 and onwards, because understanding history is very important for economics in my personal view. So that's going to be the video for the day in terms of the fundamentals, looking at some interesting charts. We're now going to get into the price action of the S&P, going to dive into the Dow Jones, but first let's just look at the global stock markets here, because they have had a little bit of a dip. Let's first look at Japan and then move down. Japan has been sideways. It has broken our little ascending zone. Not super valid just yet, but it has broken our little ascending zone. I would like to see the price kind of create a lower low structure. We do see a nice potential support zone kind of like here. We'll see how it goes, but we did break the ascending zone, but we're not really seeing any falling or any capitulation or anything like that. It's just consolidating slowly sideways. Let's just see how much it dropped from here. Dropped 2.4% around there. So not a crazy drop, but we are seeing a little bit of weakness from the buyers in the Japanese stock market, the Nikkei 225. Canada's TSX also broke the ascending zone, although it did make a higher low, and it's making a higher, not really a higher high, but it made a low, and it's kind of still climbing up here within the supply zone. So we are seeing a little bit of weakness from the buyers, but the sellers are not taking charge just yet. We're seeing the bulls hold the price just above or just below the 50% fib range. So we'll see how it goes. We're just still within the supply zone. Germany did take a little bit of a move down here with the high. Let's just see how far it moved. Yeah, around 5%. So nothing crazy, but we're definitely still seeing the German DAX 30 move to the downside. The major key zone that I'd like to see the price hold would be this major level right around here. We see that we could see a potential head and shoulders where we see a left shoulder. This is the head. If we move back down towards the 10K and move up towards the 10.7, 10.8, that could be a nice little head and shoulders that we could be looking for. But overall, definitely don't see enough weakness just yet. We did see a lower high form, which is good for the bear case, but still no major momentum coming in for the downside for Germany. FTSE 100 or the UK stock market is also similar to the DAX, where we have made a low, made a lower high, so it's looking a little bit weaker right now, but at the end of the day, I don't really see any momentum coming just yet. We did break the ascending zone, so there is a little bit of sell pressure coming into the market, breaking the support zone, but we do see that the price is still holding our little level of support there, and I think if we do want to be looking for any exposure, we'd like to see the price make a little bit move to the downside, a little bit of momentum coming in before we actually start to look to get any exposure to some shorts. But we did see that the price did make a high, made a low, and it looks like it's making a lower high, which could be a little bit more bearish for the price and the structure of the market. But definitely not to want to enter just yet, because in my opinion, it's still not really gaining any momentum. We could just see some sideways consolidation before we start to see the major momentum to the downside. The S&P is the biggest bouncer out of all the different exchanges. There's something to be said about that. We are still within that 61.8 to 50% fib level, though we are seeing a lower high. Ideally, it'd be really good if we saw this hold, because that would complete the right shoulder of the head and shoulders, and then a breakout would be around 2745, 2750 for the key level of the neckline that we'd like to see break before we look to enter on our short. The Russell 2000, which is the small caps, is still making some higher highs and higher lows. It did hit the 50% fib level, which is pretty significant, and then we can draw in another little zone like here. So we're creating a little ascending channel to the upside. We could get another push to the upside hitting the 618, so we do have to be patient. But at the end of the day, this is still a exhaustive move. This is still a pullback in my personal view after the major impulse move to the downside, which is that first bearish push. And we are looking for that next push to the downside, that P2 for those individuals who have been following this channel for a while. We are still looking for it. We have not been able to find that good opportunity to enter just yet. We did enter a little bit here, took an L, but that is completely okay with the very significant risk rewards that we're looking for within these short opportunities. It is very alright in my personal view to take a loss because for one, we're limiting risk. We're not saying we're going to short, and we have no idea when we're going to get out. If we are wrong, we have very strict discipline risk-reward situations that we are entering in, and if it doesn't look favorable for a risk-reward, we get out and look for another opportunity to attack to get that solid risk-reward, high-probability, dependable trade that we are looking for. So that's the overview of kind of Eurozone, Japan, and America in the different, well, I guess Canada too, the Western world as well as the Eurozone and a little bit of Japan here for the different equity markets. Now we're going to go into the Dow Jones because that's not shown in that little list of indexes. So DJI, we have very similar structure to the S&P 500, where in my opinion we do have a nice head and shoulders coming into play, where the right shoulder, if it does hold below the 50% zone, would be a very good probability that we could see this head and shoulders play out. Let's just get our brush, and we have our left shoulder right here, we have the head, and then we have a potential right shoulder right here. We might get a little bit of a consolidation, but we have the left shoulder, we have the head right here, and then we have the right shoulder on this zone here. So I still see the market as such, and I'm not really going to change my bias because the fundamentals are still bearish. Technicals are looking pretty favorable. I don't really have new information that's going to change my bias in any way. We have been looking at the U.S. economy potentially starting to open up again, but this could create a second wave, which would be another catalyst for the next leg down, but we don't exactly know. Theoretically, yeah, it could just continue going up, and we would only be losing out on one trade. We're not going to basically take a bias with we're not going to take a bias to the grave with us, meaning that we're not going to have so much conviction and so much bias that we'll never be able to change our viewpoints. We have to be able to be flexible, but at the end of the day, I do have pretty high conviction that the market will continue going down, because there's no way in hell that 25 million people unemployed with 16-17% unemployment, and basically every economic indicator showing that we are in a massively bear market in terms of the health of the economy, we're going to have the stock market roar. Unless the U.S. Federal Reserve debases the currencies so much that it's not like you're getting value from the stocks, you're just losing less value when you're holding stocks compared to the US dollar. So it's not a good place to be in if you're devaluing the currency so much that the stock market's going up. Venezuela did the exact same thing. During the hyperinflation in Venezuela, the stock market was in a massive bull market. But the projections for the revenues were declining. The profitability for the companies were declining because the economic state was so bad. But the value, the number of units of currency it takes to buy that one equity is getting greater and greater, because the debasement is getting greater and greater. It's not like the value of the company is going up. It's just the value of the currency is going down. So that theoretically could happen. I'm not saying that it can't happen. I'm just saying that it's going to be very difficult for that to occur because of the deflationary pressures that are currently surrounding the U.S. economy. And that's why I think that the economy is going down. The health of the economy is obviously poor, but then also the deflationary pressure of the velocity of the demographics is going to add additional difficulty for any inflation to occur, in my personal belief. So we'll see where it goes. It is a speculation. I don't have any guarantees that it will go down, but that is going to be my bias, and I'm going to stick with it because I just don't think that the Fed will be able to completely save the day, and they have magical superpowers that is able to basically curb any sort of economic turmoil, and will always be able to look up to the Fed and basically have them take care of everything. I just don't think that's possible. We've seen in the past, the more central banks try to meddle with things, the worse it gets. Central banks aren't, in my opinion, necessarily helping the economy. Yes, in 2008, they created QE, and yes, you could argue that they did save the economy, but the way I look at it is, if they didn't do anything, yes, it would have been bad. It probably would have been a little bit worse, but they wouldn't have built up this massive asset bubble that they're still building to this day. It's like, instead of letting a wound heal, you are putting a Band-Aid on it that makes it look like it's better, but that wound is actually getting more infected because you're not letting it breathe in a sense. There are cycles to everything in stock markets, in human psychology, in seasons, everything. And in my opinion, there has to be bear markets. It's inevitable. You have to accept them because, like anything, there's going to be ups and downs in life. And basically trying to eliminate bear markets altogether in an economy, that's what the Fed is trying to do, is basically eliminate all bear markets. Nothing can go down. There can only be forever expansion. That's the type of mentality that these Keynesian economists are trying to deploy, is a never-ending expansion of the economy. There's never a downside. There's no risk. Leverage up, buy more. That's like the mentality, and I just don't believe that. Maybe I'm usually an extreme optimist in life, but in this certain circumstance, I think that there is not fraud, but there is a level of criminality from the Fed just by not having free markets, by basically creating not a rigged system, but a market in which reality does not have to be in line with the prices of assets, because they can literally print value and blow you under the dust. If you think a company is overvalued, the Fed doesn't care. They can and potentially will print new money, buy up whatever shit asset they can, and basically keep the momentum going to the upside. Keep these zombie companies from continuing, which is only going to exacerbate the problem when it inevitably does hit. So that's my video for kind of like the macroeconomics talk. Let's dive into more of the charts here. Looking at the SPX daily first, we can see that yes, the 2875-ish zone is holding for that nice right shoulder. Like I said before, waiting until the price does break below the 50% would be a better opportunity to get a little bit more dependability for this entry. For the head and shoulders, it already broke our wedge here, so it does look a little bit more bearish, but having obviously the Fed print a lot of money and a lot of stimulus coming into the market, I think it would be a little bit safer to enter at the completion of the normal head and shoulders for this pair. But yeah, definitely still looking for shorts in this market. Taking a little bit closer on the 4-hour, we can see that we are stalling quite a bit at this zone of confluence. Let's take our snip and discuss this zone of confluence we see right now within the price action. First off, definitely this key zone of horizontal resistance is going to be the first level of supply. We can see right here, and we can see right here, and we can see right here. Key level of both support and resistance in the past, which is going to create our first level of supply for the price action. Second thing we see is this ascending zone right here. We have an anchor point. We see resistance, resistance, support, 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 and that's going to be a new level of resistance. So we see a zone of confluence for sell pressure within the current zone for the potential right shoulder. If it does hold and we do see some sell pressure bring the price back down to around 72.50, which is our breakout point, that'd be looking very, very favorable, because we see the left shoulder, we see the head, and then we see the right shoulder coming into play. Left shoulder, right, oh sorry, this is the head, and then this is the right shoulder, and then this key level of supply would need to hold before we actually confirm that this pattern is a valid pattern to trade. But it's still looking pretty favorable. We could even see something like this, where you see touch and then another touch, maybe a couple times, creating a descending triangle, just creating that consolidation even further to the sideways momentum before we break our key zone at 2720, 2750, somewhere around there. But that's my viewpoint. Let's just quickly look at the reverse inverted chart of the S&P 500, and it looks pretty good. Obviously, it's the exact same analysis, but to the inverted version. And we have been seeing lower lows and lower highs continuing to the downside. We saw a lower low here. We saw a lower high. So it's still moving to the downside. We don't really want to be looking for any longs just yet on this chart, which would be a short on the actual instrument. But what we're seeing is a potential higher low here. And then if we're able to connect the higher lows, and then if we were able to get maybe one more touch of this higher low, and then we got an ascending triangle, which would be right here. So this is a bearish push to the downside right here. We need some level of a consolidation where we're going to stop the lower lows and lower highs, and we're still trading lower lows and lower highs. This is a low, this is a lower low, but this is a potential higher low. This is a high, this is a lower high, so we're still making these lower lows and lower highs. Definitely still too early to be looking for longs, but what we can see is it's potentially creating from a downtrend into a consolidation. How do we know that? We were obviously making lower lows and lower highs. We created a higher low right here, and then now, in my opinion, we could see the consolidation continue upwards, where we're seeing a higher high, or at least holding of the high, and then we form a higher low. So then we have 3 higher lows. That is, in my opinion, enough dependability for me to call it a consolidation from a downtrend to a consolidation sideways. And then if we form a series of low, higher, low, higher, low, that will confirm my ascending triangle, and then I'd be looking for a breakout at around 27.30, 27.50, like we have talked about in the normal chart. So the viewpoint for the inverted and the normal is exactly the same. We're looking for that next leg to the upside, testing the high, maybe even breaking it, but that is what we're looking for, is we're looking for that shift from a downtrend to a consolidation to an uptrend. And I think that this zone, this 27, let's say 50, 40, somewhere around there, is going to be the major level of consolidation that we want to see break before we look for any entries for an upside move. But yeah, we'll see how it goes, which would be obviously super bearish for the S&P. This is an inverted chart. So then if we zoom all the way back, it should be pretty bullish now, because we saw slow, boom, and then obviously you're seeing a nice pullback, and ideally you're seeing that next leg, next boom up to the upside here, ideally in our case. So that's the analysis for the inverted chart. I don't really have much to show. We will be doing another video on gold and silver, so we're going to stick this strictly with the equities within the indexes, and don't really have much more to say on that. We're going to end off with the US dollar index, which is DXY, comprised of 60% euro, 15% yen, and then there's GBP, Corona, and franc in there as well. I don't know the exact percentages, but it's 60% euro, 15% yen, like 12% GBP or something along the lines of that, and then all the other currencies smaller than 10%. So the US dollar index is, in my opinion, in a consolidation. We had a massive volatility event when we had that liquidity event occur, where basically all assets absolutely plummeted. That's when the US dollar rose, because if you're selling anything in a commodity or US equity, you're buying up the US dollar, which obviously pushed that up significantly. And now we're in a consolidation, holding the 98.70 zone as a key level of support, and our main level of supply is around $100.88. We could draw a little descending zone like so, which could create a little bit of a squeeze, but the main zone I'm looking for is going to be $100.90, somewhere around there. So we got a move to the upside. We're in consolidation. I think we could see another move to the upside if we do see a sell-off within the equities market again. But like I said yesterday, I am long-term bearish on the US dollar strength, just because of the money printing of central banks wanting to create inflation. How do you create inflation? You can devalue the dollar to try to create inflation, which is probably what they are going to do. So we'll see how it goes. I'm not really going to be trading this, but it is important to understand where the dollar currency index is potentially going, or where the dollar's strength is going. So right now, not really doing anything a whole lot. We're just seeing a nice consolidation. We did break out of the squeeze. I can probably close that out. And then if we really wanted to, we could create a nice little descending zone, but I think I'm just going to leave it within the consolidation. We got a little resistance, we got a little support, and we're just bouncing off of both zones right now, for that. So that's going to be the end of this video. We really hope you enjoyed it. We will talk about gold and silver in a little bit here, because they are looking to create a pretty significant move. So we're creating a nice squeeze here for gold as well as silver. Silver is in a little bit more of a peculiar spot compared to gold, but gold's previous $1,700 zone is now testing as a new level of resistance, squeezing from the descending trend line that we see right here. So it's looking pretty favorable, but like always, we want to wait for a break to get the highest probability entries that we can. Thank you very much for watching. We don't really have much else to talk about in this video. If you found this useful, if you found this informative, if you found this educational or entertaining, anything above, it'd be great if you would subscribe. If you want to have a question answered, just drop them in the comment section below, and yeah, we'll try to help you as best we can. We hope that you are enjoying these recordings or these videos. I am as well. I gained some more information just by trying to collect information or data to provide in an unbiased way. Obviously, I do have a little bit of bias to the short side, but as a trader, you do have to have some sort of bias when you are trading. You can't always be unbiased, or else you're just never going to make any money. You got to have a bias, you got to have a narrative, you got to have a story that you're telling yourself and a reason why you are entering the market. You could be a technical trader and just look at technicals. You could be a fundamental investor, but I do think that in these larger swing trades, having the fundamentals and the technicals marry and create confluence in your trade will give you a higher probability situation to make money in this market. So that's going to be my viewpoint. I'm not really day trading or anything. I used to a lot more, but now with so much going on, I'm just trying to capture the large major market move in this very market, because there's a lot of noise, there's a lot of uncertainty, and I'm just taking a step back, trying to gather as much macroeconomic information as I can and try to really understand where the next couple of years are going, because in my opinion, there's going to be some huge moves. In short, I think that the big move in equities is going to be down. And the big move for the upside is going to be gold, maybe silver. Silver is going to be, I think, a bit of a lagger, but silver absolutely explodes when it does move up. So going to still keep an eye on that. But I think gold and cryptocurrencies is going to really be the movers to the upside in 2020, 2021, compared to the equities, where it's going to be more stagnation, deflation, where it's going to be either more sideways or downwards. So that's my bias on the macroeconomic scale in terms of where the capital flows will be. I've been explaining my reasons for that in many videos. So thank you very much for watching. I hope you enjoyed it. And until next time, have a good one, everyone.